Imagine our stick figure walking into a business office with one goal: acquire a business worth about $1 million. Not build from zero, not chase a random idea. Buy an existing company with customers, revenue, employees, systems, and history. This is business acquisition, and it usually moves through 5 stages: finding deals, screening them, making an offer, doing due diligence, and closing the transaction. First, find deals. Many beginners only search public business for sale websites, and those can help, but a stronger search is broader. A buyer might contact brokers, talk to accountants and attorneys, network with owners in a specific industry, join local business groups, or build a list of companies and reach out directly. The goal is not any business. It is a business that matches your skills, risk tolerance, budget, and operating plan. For a $1 million acquisition, understand what that number means. Is $1 million the asking price, estimated value, annual revenue, or purchase price? Price matters, but cash flow matters more. A company with $1 million in revenue can be very different from one with $1 million in profit. Before getting excited, ask, how does this business make money? How stable is that money? And what must stay true after a new owner takes over? Next comes screening. Think of sorting files on the office desk, looking for red flags and strong fundamentals. What does the business sell? Who are the customers? Are sales growing, flat, or shrinking? Is revenue concentrated in 1 or 2 clients? Does the owner handle everything? Or are employees and systems in place? Are leases, licenses, supplier contracts, or equipment critical to operations? At this stage, you are not proving the business is perfect. You are deciding whether it deserves more time. A simple checklist helps. Industry, location, asking price, seller motivation, revenue trend, profit trend, customer concentration, employee dependence, and reason for sale. If too many answers are unclear, ask better questions, or move on. If it still looks promising, the next step is a conversation with the seller or broker. Professionalism matters. Do not begin by demanding confidential information. Show that you are serious, respectful, and capable of following a structured process. Sellers often care about more than price. They may care about employees, legacy, timing, confidentiality, and whether the buyer can close. After initial conversations, the buyer may sign a non-disclosure agreement and review basic financials, such as profit and loss statements, tax returns, balance sheets, revenue reports, payroll summaries, and major assets and liabilities. Now you are forming a reasonable view of value. Valuation is not magic, and it is not just the seller's asking price. Many small businesses are valued using a multiple of earnings, often sellers' discretionary earnings or adjusted EBITDA. Multiples vary by industry, size, growth, risk, and financial quality. Advisors can help. The purpose is not to win an argument. It is to understand what price makes sense for the risk and cash flow. Then comes the offer. Many buyers start with a letter of intent, or LOI. An LOI is usually a non-binding outline of proposed terms, though parts like confidentiality or exclusivity may be binding. It can include purchase price, assets or equity being purchased, financing assumptions, seller financing, transition support, timeline, and major conditions. For example, a buyer might propose part paid at closing, part financed by a lender, and part paid over time through seller financing. But deal structure is not one size fits all. Every acquisition has legal, tax, financing, and operational considerations. So this is general education, not personal, financial, or legal advice. If the seller accepts the LOI, due diligence begins. This is the deep inspection phase. Our stick figure is no longer just walking through the office. Now they are opening file cabinets, reviewing spreadsheets, checking contracts, and asking detailed questions. Due diligence usually covers financial, legal, operational, commercial, and sometimes technical areas. Are the numbers accurate? Are there lawsuits, liens, contract issues, or compliance problems? Can the business keep running after the sale? Are customers loyal, the market healthy, and the competitive position defensible? This is also when financing is finalized. A buyer might use personal capital, bank financing, investor capital, seller financing, or a combination. Lenders and investors want documentation, projections, and confidence that the business can support the deal. If financing depends on unrealistic assumptions, the deal may not close, or it may create pressure later. If due diligence reveals problems, the buyer can renegotiate, ask for protections, change the structure, require fixes before closing, or walk away. Walking away from a bad deal is not failure, it is disciplined acquisition. Finally, closing.